Hello everybody, welcome to the 9th of our CIMA F3 Financial Strategy lecture recaps. This lecture was on further investment appraisal. The first thing we looked at was risk and uncertainty. So remember that uncertainty is when we can't assign probabilities to an event. Okay, and if it's over a longer term, the uncertainty is likely to be higher. So we can't calculate the probability of the event, but we know it's uncertain. So what we can use is sensitivity analysis. So in terms of the analysis that we'll be doing, it's the change required to make our net present value equal to 0. Okay, so if a variable changes by what amount to make the net present value 0. So we're looking at the effect on the net present value of different areas of the investment, i.e. different costs and different returns. How do we do that? Well, we do the net present value of the project over the present value of the item. That item, as I say, might be the initial investment, it might be the costs on the way through, but that will give us the sensitivity margin for each item. And we did a little example of that in class. The weaknesses of doing this, well, the variables may be interdependent, whereas when we're doing those calculations we're assuming they're independent. And we don't know the probability, so we're really only just working out what would happen if this does occur. We're not saying it's likely to occur or not likely. So risk then, well, risk can be assessed by probabilities. It can be quantified. As we said, we use the probabilities, and we do that using expected values. The formula for expected values is this, where P is the probability of the event and X is the value of the outcome. And we did some examples of that in class. You should have met this on your previous studies as well. So that brought us on to lease versus buy. So should we lease an item or should we buy it outright? So what we need to remember are the relevant costs for each. For leasing an item, the relevant costs are the lease rental, and remember that we get tax relief on that lease rental. So you'll need to multiply the rental amount by the tax rate to get the tax relief that you get on the lease amount. When we're buying, the relevant costs are the cost of the item, the residual value that we sell it for at the end of the term, and remember that you will get tax relief because you bought the item. So you get tax relief in the form of written down allowances, which we've already met in our NPV calculations. So the method to do this, we do an NPV calculation for both leasing and for buying, and then we discount using the borrowing rate that we're given in the question. Remember that the borrowing rate has to be adjusted for tax, so make sure you do that. So it'll be the borrowing rate times 1 minus t. Adjust for tax and use the lowest NPV cost. Remember that these are costs, not returns, so we're using the lowest NPV cost. And we did a little example of that in class. Equivalent annual cost then, this is telling us when best to replace assets. The steps in doing this, well, we calculate the present value for all items. So say we're told that we can replace an item every 1 year or every 2 years. We calculate the present value for both of those on the basis of 1 year and then on the basis of 2 years. And then we calculate the equivalent annual cost. We use the present value of all costs over the annuity factor taken from the annuity tables. And again, we want to choose the lowest because the one with the lowest equivalent annual cost will be the best. We did an example of that in class. Remember also that we can do an equivalent annual annuity, which is basically how much you would have to earn in the same amount each year to get a certain NPV, and that will be our NPV over the annuity factor, which will give our equivalent annual annuity. Again, we did an example of that in the notes in class. That brought us on to capital rationing. Remember there are two types of capital rationing. First of all, hard capital rationing. This is externally imposed, i.e. imposed from outside the organisation. For example, the banks won't lend to you. Why would this be? Well, it may be a recession, as there is at the minute. It could be that your company has a bad credit record, or that you don't have any security to put up for the lending. It could also be that the banks, etc., don't value your management and think that you have a poor management team. Soft capital rationing, well, this is imposed internally, i.e. managers decide that they're not going to undertake any more projects. Why might they do that? Well, they may have limited skills and feel that they want to concentrate on one project. They may want to limit their exposure, or they may want to focus on current projects and think that that takes up all of the time that they have available. So we can use the profitability index to decide what projects we're going to undertake. If we have divisible projects, i.e. you can do a little bit of a project and then a little bit of another one, well, what we can do then is do all of the most profitable and then do as much of the next profitable as possible. That's if you can devise the projects. Okay, and we use the profitability index to check which is the most profitable, which is the NPV of the project over the investment cost. That gives us our profitability index. We can then set up a table which shows us which is the most profitable and which of the next ones we should do, and we did an example of that in the notes. If the projects are non-divisible, well, it's just trial and error. You'll have to see which is the most profitable and then try putting two projects together and seeing what NPV you get to. It's just trial and error. See what's the best for the business in particular. And that was our lecture on further appraisal.